Okay, imagine this for a second. A world where these tiny, really agile drones, maybe costing as little as $500, can take out multi-million-dollar tanks. I mean, it sounds like something straight out of science fiction.
Right, but it's not. It's the
Nah.
reality of modern warfare.
Exactly. And it's fundamentally reshaping the entire defense industry, like top to bottom. So today we're taking a deep dive into AeroVironment Inc. That's AVAV, if you're looking at the ticker. They've been a real pioneer in this space, creating the combat-proven unmanned systems you've probably heard so much about. But this isn't just a story about drones anymore. It's really about a company undergoing this massive strategic transformation. And it's happening right now at a really critical inflection point in its history.
Yeah, and for our sources on this deep dive, we've drawn from a really comprehensive investment research analysis, looked at the company's own financial reports, industry forecasts, basically a lot of material. We spent a good chunk of time digging through it all, trying to pull out the most important nuggets, the key insights. The goal is to give you a clear, well-rounded picture of where AeroVironment stands right now and, crucially, where it might be headed.
So our mission today is really to unpack how AeroVironment is evolving. We want to look at the incredible opportunities that seem to be ahead for them, but also the significant risks they're facing, because this isn't easy.
No, definitely not.
And we want to figure out what all this means for their future and maybe even more broadly for the whole defense technology landscape. It's a fascinating story, really. Innovation, big geopolitical shifts, and what feels like a high-stakes bet on the future.
It absolutely is.
Okay, so let's unpack this. Where do we start? Maybe the big picture of this transformation.
Now let's do that.
We're starting with a company that, traditionally was the market leader in tactical unmanned aircraft systems, UAS, and these things called loitering munitions. Think Switchblade.
The classic AeroVironment.
Right. But our analysis highlights that they've embarked on what the reports call an ambitious and transformative strategy. So what's really driving this change? Why now?
Okay, the biggest single driver, you absolutely have to point to the recent acquisition of BlueHalo. That closed back in May 2025.
Right. That was huge news.
It was massive. And it fundamentally repositioned AeroVironment. They went from being, like you said, a specialized hardware provider, drones, munitions, to becoming what our sources are calling a diversified mid-tier defense technology prime.
Okay, break that down. What does prime mean here?
Well, it means they're stepping up. They now have capabilities spanning air, land, sea, space, and cyberspace. So for you, the listener, think about it this way. They can now offer much broader solutions, integrate different technologies. It's not just selling a drone, it's selling a whole system, potentially across different warfighting domains.
So it's not just an add-on, it's like a total shift in identity.
Exactly. It's a complete shift. They're trying to move up the value chain, compete for bigger, more complex contracts.
And this transformation isn't happening in a vacuum, right? The report points to powerful geopolitical tailwinds. What does that mean for their business, practically speaking?
It means a surge in demand, a really significant one. The effectiveness of unmanned systems, especially what we've seen in Ukraine, has driven what the analysis calls a secular increase in global defense spending.
Secular meaning. Long-term, not just a blip.
Exactly. This isn't seen as a temporary trend. It's viewed as a sustained shift in military thinking, in doctrine, all around the world. Countries are realizing they need these kinds of capabilities.
And that flows directly to AeroVironment.
Directly. It's led to their record-breaking funded backlog. That's the amount of confirmed orders they have. It's more than doubled in the past year. That gives them what the reports call exceptional revenue visibility. Basically, they know a lot of money is already locked in for the near future.
Okay, so they're riding that wave?
They are. And they're leveraging it. They're investing in manufacturing capacity to meet the demand, and critically, they're focusing heavily on software, AI, and autonomous systems. They're trying to strengthen their technological moat, make it harder for competitors to copy them or catch up.
But transformation, especially one this big, this fast, it often comes with complexities. Our sources mention significant complexities and risks. What should we be aware of on that front?
Yeah, that's the other side of the coin. The BlueHalo acquisition, while it looks strategically brilliant on paper, has created this material divergence between their GAAP financial results and their non-GAAP operational performance.
Okay, GAAP versus non-GAAP. Always tricky.
Always. So GAAP is the standard accounting rules, and under GAAP, their results are getting hammered by these huge non-cash amortization charges.
Amortization. That's like spreading the cost of buying BlueHalo's intangible assets, right? Like patents, brand value.
Exactly. When they bought BlueHalo, they didn't just buy buildings and equipment. They bought know-how, customer lists, technology, intangible stuff. Accounting rules say you have to gradually write down the value of those intangible assets over many years.
Which isn't actual cash leaving the company each quarter.
Right. It's an accounting charge, not a cash expense. But it makes their reported GAAP profits look much, much lower, sometimes even showing a loss, even if the underlying business is actually generating good cash flow.
So that makes valuing the company using traditional PE ratios difficult.
Very difficult. It complicates things massively. And on top of that, competition is getting fiercer across all their key markets. Their first-mover advantage in things like loitering munitions is real, but it's being challenged. There's a constant risk of technological obsolescence if they stand still for even a moment.
So putting all that together, the growth, the transformation, the accounting complexities, the competition, what does this mean for its current market valuation? How's the market seeing AVAV right now?
Well, the valuation is, let's say, rich. It reflects a market that seems to be pricing in flawless execution and sustained, high-paced growth.
Meaning investors expect them to do everything perfectly.
Pretty much. Current valuation multiple, things like price to earnings or enterprise value to EBITDA, are really stretched compared to both AeroVironment's own history and the wider aerospace and defense sector.
So market's betting big on the future.
Entirely. The current investment thesis seems predicated entirely on AeroVironment's ability to actually deliver on that massive backlog, to successfully integrate BlueHalo and realize all the promised synergies, and to capture a really significant share of this future defense tech landscape.
Which raises a big question.
Exactly. Is the market expecting perfection? Because the current price seems to leave very little room for error. Any slip-up, any delay, any integration hiccup, and that valuation could come down fast.
Okay, let's dig deeper into how the business itself has been reshaped. AeroVironment started as this specialized designer of really innovative drones.
Right, think tiny hummingbird drones, things like that initially. Very cutting edge.
But our research shows that through a series of these strategic acquisitions, especially BlueHalo, they've fundamentally changed their whole business structure. So what does this new structure actually look like today?
Okay, so after the BlueHalo deal closed, that was May 1st, 2025, they restructured into two main business segments. And this really highlights that pivot we talked about, moving from selling platforms, individual drones, to offering broader solutions.
Makes sense. What are the two segments?
First, you've got autonomous systems, which they call Access. This is basically the core legacy AeroVironment business. It holds their market-leading portfolio of unmanned systems and loitering munitions. It's the foundation.
And how big is that part?
In the first quarter of their fiscal year, 2026, Q1 FY26, the ACSS segment brought in about $285.3 million in revenue. And within ACSS, you've got three main product lines. You've got the small unmanned aircraft systems, SUAS. These are the combat-proven ones like Puma, Raven, Waspy. Think of them as the small tactical eyes and ears for troops on the ground. ISR intelligence, surveillance, reconnaissance.
The ones they've sold globally.
Exactly. They're a global leader here. Sold systems to over 55 allied nations. Really crucial for small unit situational awareness. Then you have the loitering munition systems, LMS. This is arguably their highest growth area right now, dominated by the Switchblade family.
Switchblade 300 and 600.
Yep, the 300 is the smaller, man-portable, anti-personnel one. The 600 is the bigger brother, designed specifically to take out armored targets, tanks, vehicles.
The ones making headlines from Ukraine.
Precisely. Their effectiveness there has given them huge prominence. It's really demonstrated the power of these relatively low-cost precision strike systems, a big driver of demand. And finally, within Access, there's medium unmanned aircraft systems, MUAS. This is mainly centered on the JMP-20.
Which they got through an acquisition, right, Arcturus?
That's right. The JMP-20 is a Group 3 UAS. It's a vertical takeoff and landing VTOL fixed-wing drone. So, bigger than the Ravens and Pumas, designed for longer endurance ISR missions. The VTOL capability is key, means it doesn't need a runway, making it really flexible.
Okay, so that's Access, the legacy business, plus the JUMP-20. What's the second segment?
The second segment is Space, Cyber, and Directed Energy, or SCDE. And this segment is almost entirely the newly acquired BlueHalo business. This is where you really see the strategic expansion into these higher-end, more advanced defense areas.
And its contribution?
In its first quarter with AeroVironment, SCDE recorded revenue of $169.4 million. And its portfolio is really diverse. You've got space-based platforms. That includes things like space ISR surveillance from orbit and developing long-haul laser communication terminals. Super important for secure, high bandwidth comms in modern warfare. Then there's directed energy. This is basically laser weapon systems, particularly focused on counter-UAS or CUAS.
Shooting down hostile drones with lasers.
Essentially, yes. Developing systems to detect, track, and zap enemy drones. Very cutting-edge stuff. They also have cyber and electronic warfare, EW capabilities. This is all about operating in environments where the enemy is trying to jam signals, hack systems, contested electromagnetic environments, making sure your stuff works and the enemy's doesn't. And finally, also under SEDE, they offer broader counter-UAS technologies. These are integrated systems, sensors, command and control, and the effectors or weapons all working together to defeat hostile drones. Kind of the defensive side of the drone coin.
Okay, this is where it gets really interesting. This isn't just adding new products, like you said. It feels like a fundamental shift in capabilities. How does this realignment, these two new segments, actually change AeroVironment's position in the overall defense market?
It pushes them significantly up the defense value chain.
Sure.
I mean, think about it. Before, they were maybe seen as a top-tier component or platform provider in specific niches, right? Drones, loitering munitions.
Right.
Now, by integrating BlueHalo's capabilities, they can step up and bid on much larger, more complex prime contracts. Contracts that require integrating capabilities across multiple domains, air, space, cyber, maybe even sea and land eventually.
So they're competing with the big boys now.
Increasingly, yes. It fundamentally expands their total addressable market, the TAM, the potential pool of money they can go after. And yeah, it puts them in more direct competition with the larger established defense primes like your Lockheeds, Northrop Grumman's, RTX's. It's a big strategic leap, signaling they want to be a more comprehensive solution provider, not just a drone specialist.
Okay, let's talk more about that BlueHalo deal. Our sources described it, closed May 1st, 2025, as the single most significant event in AeroVironment's recent history. Just how transformative was it in terms of pure scale and the financial picture?
Oh, profoundly transformative. I mean, look at the numbers for that first quarter, Q1 FY26. BlueHalo contributed $235.2 million to AeroVironment's total quarterly revenue of $454.7 million.
Wow, so BlueHalo alone was more than half the total revenue that quarter.
Exactly. It effectively doubled the size of the legacy AeroVironment business almost overnight. And it wasn't just product sales either. That BlueHalo contribution was split pretty evenly, $123.7 million in product revenue and $111.5 million in service revenue.
That's a huge shift. What did that mix adding so much service revenue do to AeroVironment's overall revenue profile? They were mostly product-focused before, right?
Completely changed it. Historically, AeroVironment was very product dominant. Selling hardware was their bread and butter. But with BlueHalo's significant services component, the overall mix for that quarter shifted to a much more balanced profile, 69% product, 31% service revenue.
Which reflects that move towards being a broader solutions provider.
Exactly. But, and this is the crucial but we touched on earlier, while it's strategically transformative, it introduces that major complexity for financial analysis because of purchase price accounting.
Right, the GAAP versus non-GAAP thing again.
Yep. So for Q1 FY26, AeroVironment reported that GAAP loss from operations of $69.3 million. And that loss was directly driven by $79.7 million in those non-cash charges, mostly the amortization of acquired intangibles. Remember, writing down the value of patents, customer relationships, etc.
So the underlying business wasn't necessarily losing cash.
Correct. When you exclude these non-cash items and other adjustments, they're non-GAAP adjusted EBITDA earnings. Before interest, taxes, depreciation, and amortization for that same period was actually a positive $56.6 million.
That's a massive difference, $69.3 million loss versus positive $56.6 million adjusted EBITDA.
Huge difference. And this creates a substantial disconnect, likely for multiple years, between the reported GAAP earnings and the actual underlying cash-generating capability of the business.
Yeah.
So for you, the listener, if you're looking at their financials, you absolutely have to focus on those non-GAAP metrics like adjusted EBITDA and free cash flow to get a real sense of the operational performance.
But it also raises questions, right, about the quality of reported earnings.
It does. You need to be aware that the GAAP numbers will look weak, maybe even negative for a while because these accounting rules, even if the core business is performing well, it requires a more sophisticated look beyond the headline GAAP number.
Now let's talk about where AeroVironment actually gets its money. Who are the customers? Our sources say revenue is overwhelmingly derived from government contracts and heavily concentrated in firm fixed price agreements. What does that really mean for the business?
Yeah, that's a really important aspect of their model. Based on the data for the 12 months ending in 2025, U.S. government customers, mainly the Department of Defense, DoD, accounted for almost 75%, 74.8% of their total revenue.
So, three-quarters from Uncle Sam.
Pretty much. And within the DoD, the U.S. Army is a particularly crucial customer. This high concentration means their performance is intrinsically tied to U.S. defense budgets, political cycles, procurement priorities. You get the picture.
Very dependent.
Highly dependent. And then there's the contract structure. It's heavily weighted towards those firm fixed price, or FFP, contracts. They made up over 91% of revenue in that same period.
And FFP means AeroVironment takes the risk if costs go up, right?
Exactly. Under FFP, they agree on a price up front. If their costs to deliver materials, labor, whatever end up being higher than planned, that eats directly into their profit margin. In today's environment, with inflation and potential supply chain issues, that model can definitely pressure margins if costs aren't managed super effectively.
But there's an upside, too.
Oh, absolutely. If they can be efficient, manage costs well, maybe find production savings, they get to keep the difference. So FFP offers a significant potential upside to profitability if they execute well and control costs better than anticipated. It rewards efficiency.
So, if they're so reliant on the U.S. government, what about geographic diversification? You mentioned they sell globally. How significant are international sales in balancing that out?
They're very significant, and increasingly so. International sales actually represent a large and growing chunk of the business. For those same 12 months ending 2025, international revenue accounted for 52.45% of the total.
Wow, over half. So they're actually more international than domestic now.
Based on that period, yes, which is a really important diversifier. It helps mitigate that heavy reliance on the U.S. budget cycle alone.
That's surprising. And where are those international sales coming from?
Well, a notable piece recently has been sales to Ukraine, which were often facilitated by U.S. aid packages. Those sales represented 18.25% of total revenue in that period.
Nearly a fifth of their revenue linked to Ukraine aid.
Yeah, it highlights just how directly current geopolitical events are impacting their top line. It shows that global demand, even if sometimes funded by the U.S., is a huge part of their business now. That international diversification is key to de-risking the U.S. budget reliance.
Okay, let's zoom out a bit. AeroVironment operates right at this intersection of, rapidly advancing technology and what feels like a deteriorating global security environment. That sounds like a powerful tailwind for their business.
It absolutely is, though maybe a volatile one at times. The global defense market is definitely in a period of what analysts call secular expansion.
Secular meaning long-term fundamental growth.
Exactly. It's not just a short-term spike.
Right.
World military spending hit an all-time high of $2.4 trillion in 2023. That was driven by major conflicts, rising geopolitical tensions.
Yeah.
The headlines. And projections show it potentially exceeding $3.4 trillion by 2030.
$1 trillion increase in just a few years.
Yeah, massive numbers. And critically, a growing slice of these budgets is being specifically earmarked for advanced technologies, including unmanned systems.
So money is flowing towards the kinds of things AeroVironment makes.
Precisely. The market just for military drones is forecast to grow at a compound annual growth rate, CAGR, of almost 14%, 13.9%. That takes it from about $40.5 billion in 2024 to nearly $88 billion by 2030.
Doubling in 6 years.
Roughly, yeah. And the broader unmanned systems market, which includes ground and sea robots too, is projected to grow at over 10% CAGR to reach almost $50 billion by 2030. These are really substantial growth trends, reflecting that fundamental shift in military thinking.
Now, here's where it gets really interesting. Our sources specifically point to the conflict in Ukraine as a powerful proof of concept.
Yeah.
How has that conflict, especially the way drones have been used there, reshaped demand globally?
Ukraine has been, brutal but an incredibly effective showcase. The demonstrated ability of relatively cheap drones, sometimes costing just $500, like you said, to find, target, and neutralize incredibly high-value assets like multi-million-dollar tanks.
Yeah.
It has fundamentally altered military doctrine, period.
It's that asymmetric advantage, right?
Exactly. It proves you don't always need a billion-dollar jet to have a decisive impact. Nations worldwide are looking at this and realizing they absolutely must invest in these kinds of capabilities, not just for fighting current wars, but as a core part of their defense posture for the foreseeable future.
So it's not just about restocking depleted inventories.
No, it goes way beyond that. It suggests a durable, long-term growth cycle for companies like AeroVironment, who are leaders in this space. Militaries are fundamentally rethinking their force structures based on these lessons learned.
And the U.S. Department of Defense, their biggest customer, is obviously seeing this too. How is this reflected in the Pentagon's budget priorities? Are they putting their money where the doctrine is shifting?
Oh, absolutely. The Pentagon's fiscal year 2026 budget request specifically calls out a huge $13.4 billion for autonomy and autonomous systems. It's a clear signal of strategic priority.
$13 billion just for autonomy.
Yeah. And on top of that, another $3.1 billion specifically for counter-UAS capabilities defending against enemy drones. Looking back at fiscal year 2025, the specific investment budget just for UAS was $2.4 billion.
So big numbers. But is it just about the money?
No, it's also about speed. There's a significant push within the U.S. government to reform and accelerate how they buy cutting-edge tech. Initiatives like the Pentagon's Replicator program are designed specifically to fast-track the production and fielding of thousands of autonomous systems.
Replicator. Trying to mass-produce drones quickly.
Basically, yes. Get large numbers of affordable autonomous systems out to the warfighter much faster than the traditional, often painfully slow defense acquisition process would allow.
This push to bypass those traditional slow acquisition pathways, it sounds like a huge opportunity for an agile company like AeroVironment, right? Cut through the red tape.
It absolutely is a significant opportunity for innovative companies like them. Getting tech fielded faster is a huge win. However, there could be a downside.
Oh. What's the potential negative?
Well, by lowering those bureaucratic barriers to entry, making it easier and faster to get into the defense market, procurement reform might also intensify competition in the long run.
How so?
It makes it easier for non-traditional defense companies to jump in. Think venture-backed startups with cool AI, or established commercial tech firms who previously wouldn't have bothered with the hassle of DoD contracts.
So new players entering the field.
Exactly. These new entrants can be very agile, often bring fresh commercial tech, and don't have the same overhead as the traditional defense giants. So AeroVironment's continued success won't just depend on out-innovating their usual competitors, but also this new wave of potentially disruptive, agile players. It's a double-edged sword. Faster procurement, but maybe more competitors fighting for the pie.
Okay, shifting gears slightly. Our sources highlight that the regulations for drones are really different for military versus commercial use. They say they differ starkly. What does this regulatory split mean for AeroVironment potentially using its military tech in, say, commercial markets down the line?
Yeah, this is a really critical point that often gets glossed over. In the U.S., commercial drone operations fall mainly under the FAA's Part 107 rules.
Right, the ones for hobbyists and commercial operators.
Exactly. And those rules apply to drones under 55 pounds. They impose pretty strict limits. You need pilot certification, aircraft registration. You have to keep the drone within visual line of sight, VLOS. There's a 400-foot altitude ceiling, and you generally can't fly over people.
Can you get waivers for more advanced stuff, like flying beyond line of sight?
You can. Waivers for BVLOS beyond visual line of sight are possible, but getting one requires a really rigorous safety case approval process. It can be complex, costly, and take a long time.
Okay, so that's commercial. How does military operation differ?
Military UAS operate under a completely separate set of public aircraft regulations. Now, they still have to coordinate with the FAA to operate safely in national airspace, but their actual operational parameters are dictated by the mission needs. They are generally far more permissive than commercial roles. They can fly higher, further, BVLOS routinely because the military mission demands it.
And there are export controls too, right?
Absolutely. The export of military-grade drone technology is tightly controlled by regulations like ITAR, the International Traffic in Arms Regulations. This governs selling defense articles to foreign nations and prevents that sensitive military tech from just flowing freely into the commercial sphere or to unauthorized countries.
So what does all this mean? Does this stark regulatory difference create a major hurdle for AeroVironment if they ever wanted to pivot their advanced military drones into big commercial markets like agriculture or infrastructure inspection?
It represents a substantial, really significant non-technical barrier. While people often talk about the long-term potential for military drone tech in commercial sectors, agriculture, infrastructure, logistics, delivery the path to getting the necessary certifications for routine commercial BVLOS operations is incredibly complex, costly, and time-consuming.
So it's not just about whether the tech can do the job.
No. It's about meeting a completely different and in many ways much stricter for routine daily use set of safety, operational, and legal standards designed for civilian airspace integration. This suggests that while commercial markets might hold some future potential maybe years down the road, the defense sector is going to remain AeroVironment's primary revenue driver for the foreseeable future. The regulatory hurdles for large-scale commercialization are just too high and too expensive right now for it to be a quick or easy pivot. They're pretty firmly anchored in defense for now.
Okay, let's talk competition. AeroVironment clearly leads in some key niches, like small drones and loitering munitions, but our sources say they face intense and growing competition from a whole range of companies. Who are the main players they're really going up against in their key markets?
Yeah, the competitive landscape is definitely tough, and it varies depending on the product category. Let's break it down. For loitering munitions, where Switchblade is king,
Right.
their primary competitors include UVision from Israel. They actually partner with RTX Raytheon to market their Hero family of munitions in the U.S. and elsewhere. There's also Textron Systems with their Battlehawk system. And critically, as we mentioned, the success seen in Ukraine has basically put a spotlight on this market, attracting numerous new entrants globally from established players to startups. So that space is getting crowded fast.
Okay, what about the bigger drones, like the JMP-20, Group 3 UAS?
That's a highly competitive segment, especially with the big prize being the U.S. Army's Future Tactical Unmanned Aircraft System Program, or FTUAS. Key competitors vying for that include Textron Systems again, with their Aerosonde HQ. There's a team from Northrop Grumman and Shield AI offering the VB-IT. You've got Griffin Aerospace with the Valiant, and Sierra Nevada Corps with their Volley-T. It's a real slugfest for that Army contract.
And the smaller drones, Puma, Raven, still competitive there.
Definitely. In the small UAS segment, competitors include major defense players like Lockheed Martin, Israel's Elbit Systems, and Thales Group from France. So even in their traditional stronghold, they're up against big, well-resourced global companies.
And now, post-BlueHalo, they're in even broader competition, right?
Exactly. With their expansion into space, cyber, and directed energy, thanks to BlueHalo, AeroVironment now competes more broadly with the really large, diversified defense contractors. We're talking Northrop Grumman, Lockheed Martin, RTX, L3 Harris Technologies, the giants. So they're playing in multiple leagues now, facing different kinds of competitors in each.
So, with all these formidable competitors, what are AeroVironment's actual competitive advantages? What are the moats, as they say, protecting your business? How do they stand out?
Well, their advantage is built on a few key pillars. First, a history of pioneering technology. Second, that portfolio of battle-proven systems. And third, the strategic shift they're making towards a software-centric ecosystem. Probably their most significant moat right now is the operational track record of their products, especially the Switchblade, its extensive, well-documented use by Ukrainian forces. That's become the defining product in its category.
That real-world validation is hard to beat.
Incredibly hard. It's a powerful differentiator that competitors struggle to replicate. You can run simulations all day, but actual combat performance. That builds unmatched credibility in the defense world. However, that first-mover advantage, while strong, is eroding. The underlying technologies for drones, autonomy, sensors, they're becoming more widespread, more accessible.
Like we saw with early PCs or smartphones.
Kind of, yeah. So the basis of competition is shifting. It's moving away from just having a novel capability towards being able to produce it reliably, at scale, cost-effectively, and crucially, integrated effectively into a broader network of systems.
Which is where the software comes in.
Exactly. Recognizing this shift, AeroVironment is investing heavily in software and AI as a key future differentiator. The introduction of their AVAV software platform is a really strategic move. They want to create this common, hardware-agnostic control system for their whole family of autonomous platforms.
Hardware agnostic, meaning it could potentially control other companies' drones too?
Potentially, yes. The goal is to create a really sticky product ecosystem. Get customers using AVAV, training on it, integrating it, and it becomes harder for them to switch to a competitor's hardware, even if the drone itself is comparable. It increases the value of their own hardware and creates lock-in. It's about building that digital moat.
Okay, let's talk results. With this intense competition and shifting landscape, how has AeroVironment actually fared in securing major contracts recently? Are they winning the crucial battles, or are they losing ground sometimes?
It's a mixed bag, which reflects that competitive reality. While getting precise market share data in these niche defense segments is tough, AeroVironment is widely seen as a leader in Group 1 UAS, the small stuff, and loitering munitions, at least for the U.S. and its allies.
Which is different from the commercial market.
Very different. The commercial drone market is just dominated by China's DJI. They have something like over 70% market share globally. Totally different dynamics.
Yeah.
Looking at recent defense contract activity for AeroVironment, It highlights both their strengths and the pressures. Let's look at a major win. In August 2024, they secured a landmark 5-year IDIQ contract with the U.S. Army.
IDIQ. Indefinite delivery, indefinite quantity.
Right. It's for lethal unmanned systems. With a ceiling value of nearly $1 billion, $990 million. An IDIQ basically sets up a framework and a maximum spending limit, and then the government issues specific delivery orders against it.
And have they gotten orders under that yet?
Yes. They've already received a big $288 million delivery order under this contract, mostly for Switchblade systems. This really cements their role as a key supplier of loitering munitions to the Army. Huge win. Provides great visibility.
Okay, so that's a big positive. What about the other side? Any notable losses?
Yes, there was a significant one. In May 2023, the company announced that its JUMP-20 UAS, the Group 3 drone, was not selected to move forward into the second increment of the Army's highly competitive FTUAS program.
Ouch, especially since they were providing it for the first increment, right?
Exactly. The JUMP-20 had been selected as the interim solution for the program's first increment back in August 2022. So being chosen as the temporary fix and then not making the cut for the long-term program, that was a significant setback.
What does that loss signal?
It underscores just how fierce the competition is in that lucrative Group 3 UAS market. It shows that even having a capable product, even being an incumbent interim provider, doesn't guarantee you win the big program of record. It highlights the risk of being dependent on winning these few, massive contracts. They lost out to 4 other competitors in that round.
Okay, let's pivot to the financials. What does all this, the growth, the transformation, the wins and losses, mean for AeroVironment's actual financial health? Our sources show a pretty fascinating story of revenue growth.
Yeah, the top-line growth story is undeniably strong and accelerating. If you look at their historical financials, say from fiscal year 2021 through 2025, annual revenue climbed steadily. It went from about $395 million in FY21 to over $820 million in FY25.
So more than doubled in 4 years.
Right. And the rate of growth picked up significantly, too. It went from 7.5% growth in FY21, hit a big 32.6% jump in FY24, and was still strong at 14.5% in FY25.
And then BlueHalo hit the books.
Exactly. In Q1 of FY26, the first quarter, including BlueHalo, total revenue just surged. A remarkable 140% year-over-year increase, hitting $454.7 million for the quarter.
Wow. How much of that was organic growth from the original AeroVironment business?
Even if you strip out the BlueHalo contribution, the legacy AeroVironment revenue still grew a very healthy 16% year-over-year that quarter. So strong underlying demand plus the massive acquisition impact.
And what are they guiding for the full year?
Looking ahead, they've issued pretty aggressive revenue guidance for the full fiscal year 2026, somewhere between $1.9 billion and $2.0 billion. That reflects the full year impact of having BlueHalo in the fold. So the revenue picture looks really robust.
Okay, revenue growth is strong, that's clear. But our sources indicate the profitability is undergoing this structural transformation, mainly because of BlueHalo. What's happening to their margins? Why is it so different from that strong revenue story?
This is where that GAAP versus non-GAAP distinction becomes absolutely critical again. Historically, legacy AeroVironment was a high-margin product company. Their gross margin in fiscal 2025 was quite healthy at 39.4%.
Pretty good for hardware.
Yeah. However, adding BlueHalo brought in a significant chunk of services business, which typically operates at lower gross margins than specialized hardware. Combine that lower margin service mix with the heavy burden of those non-cash amortization expenses from the acquisition, and it's really pressuring the reported GAAP margins.
How much pressure are we talking?
In Q1 FY26, their reported GAAP gross margin plummeted to just 21%. That's a huge drop from 43% in the same quarter the previous year.
Wow, cut in half.
And that drop was almost entirely due to a $37.4 million charge, specifically for the amortization of acquired intangibles hitting the cost of goods sold line.
So an accounting charge is tanking the reported gross margin.
Precisely. And that accounting impact flows right down the income statement. It resulted in that reported GAAP net loss of $67.4 million for the quarter. It makes the profitability look dramatically worse on paper than the underlying operational performance might suggest.
This sounds like a really stark contrast to the booming revenue story. So how do we, as listeners trying to understand this, get a handle on the true underlying profitability beyond these potentially misleading GAAP figures?
You absolutely have to look at the non-GAAP metrics that management provides. They usually give a reconciliation. showing how they get from the GAAP number to their adjusted figures.
Like that adjusted EBITDA number you mentioned earlier.
Exactly. We saw that despite a GAAP loss from operations of $69.3 million in Q1 FY26, if you add back things like that $79.7 million in total intangible amortization across cost of goods and operating expenses, stock-based compensation, acquisition costs, etc., you arrive at that positive non-GAAP adjusted EBITDA of $56.6 million.
So operationally, they were profitable on that adjusted basis.
Correct. And management has guided for a full-year fiscal 2026 adjusted EBITDA between $300 million and $320 million. So what you, the listener, need to do is kind of recalibrate your expectations. The combined company's long-term margin profile, especially on a GAAP basis, will likely be structurally lower than AeroVironment's historical levels because of that higher mix of services revenue from BlueHalo.
And you just have to accept the GAAP numbers will look messy for a while.
Pretty much. It's very common with big transformative acquisitions like this. But it requires that extra diligence to look past the GAAP headlines and understand the cash-generating power of the actual business operations using those non-GAAP adjustments.
Okay, let's talk backlog again. It's such a critical metric for defense companies, giving that visibility into future work. Our sources show just exponential growth here. Can you walk us through the scale of this backlog and what it really means?
Yeah, the growth in their funded backlog has been truly explosive. It really reflects that surge in demand we've been discussing. Let's look at the numbers at their fiscal year ends. April 30, 2024, end of FY24 backlog was $400.2 million. April 30, 2025, end of FY25, it jumped to $726.6 million. That's an 82% increase year over year. And then, just one quarter later, August 2, 2025, end of Q1 FY26, it $1.1 billion. That's another 51% jump just from the end of the previous fiscal year.
So from $400 million to $1.1 billion in just over a year. Incredible growth.
It really is. And that's just the funded backlog, confirmed orders with money allocated.
Is there more beyond that?
Yes. In addition to the funded backlog, they also reported an unfunded backlog of $3.1 billion as of that same date, August 2, 2025.
Unfunded meaning contracts awarded but waiting for specific funding approval each year.
Generally, yes. Or options on existing contracts. So if you add funded and unfunded together, their total backlog stood at a massive $4.2 billion.
Okay, $4.2 billion total. What does that signify?
Well, first, it provides an exceptional level of revenue visibility, like we said. It really de-risks their near-term forecasts. They know a lot of work is already lined up.
But is there a downside to such a huge, concentrated backlog?
There can be. It also means that a significant chunk of their future revenue is concentrated into potentially just a few very large multi-year contracts, like that big Army LUS program for Switchblade.
So concentration risk.
Exactly. Any delays in those specific large programs, any changes in funding for them, or any execution issues on AeroVironment's part could have an outsized negative impact on their overall financial results. It's great to have the work, but it raises the stakes on executing those key programs flawlessly.
Okay, let's talk about staying ahead. How does AeroVironment plan to maintain its technological edge in such a fast-moving, competitive industry? Where are they investing their R&D dollars?
They maintain a pretty significant investment in R&D, research and development. In fiscal year 2025, they spent $101 million on R&D. That worked out to about 12.3% of their revenue.
How does that compare to others?
It's quite substantial, especially compared to many of the larger diversified defense primes who often spend a lower percentage of revenue on R&D. It shows a real commitment to innovation.
And what's the focus of that R&D spending? Is it just building better drones?
What's really interesting here is the apparent shift in focus. It seems to be moving away from primarily developing new physical platforms, the next drone model, towards creating the underlying software, AI, and autonomy capabilities that can be used across their entire portfolio.
Like that AVHalo platform you mentioned.
Exactly. Initiatives like AVHalo, their common control system, and things like their SPOTR Edge computer vision technology. These are examples of investing in that common software and AI backbone.
Why that shift? What's the strategic goal?
By investing in that common foundation, they aim to do a few things. One, enhance the value of all their hardware, make every drone smarter and more capable because it runs on better software. Two, create that more integrated, sticky product ecosystem we talked about, make it harder for customers to leave. And three, potentially open up new, higher-margin revenue streams related to software licenses or data services in the future. It's a move towards being more of a tech company, less just a hardware manufacturer.
Now, besides internal R&D, our sources confirm that mergers and acquisitions, M&A, have become AeroVironment's primary tool for rapid scaling and capability expansion.
It sounds like a really aggressive growth by acquisition strategy.
It absolutely is. They've executed a series of acquisitions that generally seem strategically logical. They've used M&A to fill gaps in their portfolio and enter new markets much faster than they likely could have organically.
Can you remind us of the key ones again? Sure. Back in 2021, they bought Arcturus UAV for $405 million. That's where the JUMP-20 Group 3 drone came from. In 2022, a smaller, tech-focused deal for Planck Aerosystems. That added advanced autonomous navigation, especially for operating from moving platforms like ships or vehicles. In 2023, they acquired Tomahawk Robotics. That brought in the Kinesis AI-enabled common control system, a key piece feeding into that AV-Halo strategy. And then, of course, the huge one in 2025, BlueHalo. That was the massive transformative deal that catapulted them into space, cyber, and directed energy.
This buy to grow and buy to transform strategy, it clearly has high potential rewards, getting them into new markets fast. But it must also carry significant risks, right? Especially with a deal the size of BlueHalo.
Absolutely, and that raises a critical question. How well can they actually integrate all these acquired companies, particularly the massive and complex BlueHalo organization? Successful integration is far from guaranteed, and it represents a significant management challenge. It's probably the key internal risk for investors to watch very closely right now. Getting the pieces is one thing, making them work together seamlessly is another entirely.
Let's talk about shareholder returns. With all this growth and investment, what about returning capital directly to shareholders? Does AeroVironment pay dividends or buy back its own shares?
Their capital allocation policy is, well, unequivocally focused on growth.
Yeah.
Full stop. The company does not pay a dividend, and it has no history of doing so.
No dividend at all.
None. And furthermore, there's no active share repurchase program in place. The most recent one mentioned in public records was a tiny $25 million program announced way back in September 2015, which is almost certainly expired or long since completed.
So what does that signal to investors?
It signals very clearly that management believes the best use of all available capital right now is reinvesting it back into the business, funding that R&D we talked about, paying down debt from acquisitions like BlueHalo, and potentially pursuing further M&A, all in pursuit of driving top-line growth and gaining market share. They're prioritizing growth over immediate shareholder payouts. It's a bet that reinvestment will create more long-term value.
Okay, let's shift focus firmly to the upside now. Let's talk bullish case. Our sources highlight several significant growth opportunities on the horizon. Where is AeroVironment seeing the most potential for expansion in the coming years?
International markets are definitely a huge one. They represent a significant and, importantly, somewhat de-risked growth vector.
De-risked how?
Well, foreign sales already make up over half their revenue, as we saw. They've got systems sold to over 55 allied nations, so they have established channels and relationships, and they're actively pushing for more international growth. They recently set up a new office in the UK, specifically to target the European defense market.
And how do they typically sell internationally? Direct sales.
A key channel, especially for military gear, is the U.S. government's Foreign Military Sales Program, or FMS. Recent contracts, like for Switchblade 300, have included FMS provisions for allied nations.
Why is FMS so beneficial for them?
The FMS program really streamlines a whole complex process of selling defense articles abroad. The U.S. government basically acts as the intermediary. They handle the contracting, the logistics, often the training and support arrangements. This reduces AeroVironment's counterparty risk. They're essentially dealing with the U.S. government, and it simplifies the sales cycle considerably. As global demand keeps growing for the kinds of systems proven in Ukraine, that FMS pipeline represents a major, high-probability growth opportunity.
Okay, international sales are key. What else is driving the bullish case? You mentioned that software ecosystem, AV-Halo, as a long-term play. Tell us more about why that's so significant.
Right. AV-Halo is really central to their long-term strategy, this hardware-agnostic software platform.
Yeah.
It's designed to be the common command and control interface for their entire suite of autonomous systems, drones, maybe ground robots eventually. And, crucially, they hint it could potentially integrate with third-party systems too.
So, aiming to be the operating system for battlefield robots.
That's a good way to think about it.
Yeah.
It's a strategic attempt to become the underlying OS for tactical autonomy. In a defense world that's increasingly pushing for interoperability and open architectures, a successful AV-Halo could create a really powerful competitive moat.
How? By locking customers in.
Partly, yes. If customers adopt AVHalo, train their operators on it, build their workflows around it,
Yeah.
it becomes much harder, more costly for them to switch to a competitor's hardware, even if the drone itself is good. It creates that ecosystem stickiness.
But is there more to it than just lock-in?
Oh yeah. More importantly, it potentially opens the door to a software as a service or SaaS business model down the line. Imagine selling software licenses, offering subscription-based capability updates, providing data analytics services based on the data collected. That could become a source of high-margin, recurring revenue.
Which investors love, recurring revenue.
Absolutely. It's much more predictable and profitable than just one-off hardware sales. So Avelo isn't just about controlling drones. It's potentially about transforming their entire business model toward software and services. That's the long-term vision.
And one more point on the bullish side, production capacity. In a defense market where demand often seems to outstrip the industrial base's ability to supply, how is AeroVironment positioned to actually deliver on all these orders?
That's a really critical point, and it's actually a key competitive advantage for them right now. Many defense companies are struggling to ramp up production, but AeroVironment has been pretty proactive in investing in manufacturing capacity.
How much capacity do they have?
They've already expanded their capacity to support over $500 million in annual product revenue, and they're actively planning for more growth. For example, they've got a new manufacturing facility coming online in Utah that's slated to more than double their production capacity, specifically for the high-demand Switchblade systems.
So they can actually build what the backlog demands.
That's the plan. This ability to deliver at speed and scale, as they put it, is crucial. It allows them to meet that surge in demand reflected in the huge backlog. In competitive procurements, especially now, the ability to deliver systems on faster timelines can be a decisive factor. Sometimes it's more important than having the absolute bleeding-edge tech if you can't produce it quickly.
So investing ahead of demand gives them an edge.
Definitely. By investing ahead of the curve, they're positioning themselves to capture market share from competitors who might have comparable technology but are struggling to scale up production fast enough. Production power itself becomes a competitive weapon.
Okay, we've covered the opportunities. Now, let's turn to the other side, the bearish case. Despite the strong growth outlook, our sources highlight some significant risk factors. What's the primary risk here, the biggest shadow over this growth story?
The biggest one, fundamentally, is probably still that heavy reliance on government contracts, particularly from the US DoD. It's inherent in the defense business, but it's a major risk factor.
We talked about the concentration, 75% US Gov.
Right. And as their own corporate filings disclose, any changes in government spending levels, shifts in defense priorities away from their types of systems, or even adverse government audits, any of those could materially impact the business, with over 3/4 of their revenue coming from the U.S. government. As of Q3 FY25 data, they're highly exposed to that feast or famine cycle of defense contracting.
Meaning future budget cuts could hit them hard.
Absolutely. If a future political environment prioritizes budget austerity, or if the DoD makes a strategic shift away from the small, tactical systems that are AeroVironment's bread and butter, that could lead to program cancellations or funding reductions. That would severely impact their revenue stream and growth prospects. It's the flip side of having such a large, reliable customer. You're also very dependent on their continued goodwill and funding.
Beyond government budgets, what about the competitive and technological risks? You mentioned the innovation race. How real is the threat of being leapfrogged or commoditized?
It's very real. The markets they operate in are characterized by intense competition and incredibly rapid technological change. Their own 10K filing explicitly warns about competition from firms with substantially greater resources.
Like the big defense firms.
Exactly. And that loss of the FTUAS Increment 2 contract we discussed, that's a tangible example of this risk. It shows that even with a capable product, winning these large programs against well-resourced competitors is absolutely not guaranteed.
And what about that commoditization threat, the cheap, good enough drones?
That's a really interesting, maybe more insidious long-term risk. The widespread, effective use of inexpensive, often modified commercial FPV drones in Ukraine. It has shown the world that you can achieve highly effective tactical results at a tiny fraction of the cost of sophisticated military-grade systems like Switchblade.
So people might ask, why pay for the premium option?
Exactly. This trend could exert significant pricing pressure on AeroVironment's products over time. It could force them to compete more directly in lower-margin segments where cost is king, potentially eroding both their technological edge and their historically strong profitability advantages. It's the risk of being disrupted from below by simpler, cheaper solutions that are good enough for many tasks.
Okay, government dependency, competition, commoditization. What about internal risks? The BlueHalo acquisition was massive. Our sources suggest its integration is a significant hurdle. What are the specific challenges there?
Yeah, the BlueHalo integration is arguably the single biggest internal risk facing the company right now. AeroVironment's own filings identify the ability to successfully integrate acquired companies as a key risk factor, and BlueHalo is just an order of magnitude larger and more complex than anything they've done before.
What makes it so complex? Is it just the financial side?
No, the challenge goes way beyond just crunching the numbers. It involves merging potentially very different corporate cultures. You've got AeroVironment's traditionally agile, hardware-centric engineering culture, and BlueHalo's larger, more services-oriented structure. Getting those two cultures to mesh effectively can be incredibly difficult.
People, processes.
Exactly. Plus, there's the massive practical task of integrating IT systems, rationalizing product roadmaps, deciding which projects continue, which get cut, how they fit together, and crucially, retaining the key technical and managerial talent from both organizations during a period of uncertainty.
If they mess up the integration.
A failure to execute this smoothly could lead to serious operational disruptions. It could mean they fail to realize the projected cost savings and revenue synergies that were the whole justification for the deal. And it could be a massive distraction for senior management, pulling focus away from winning new business or innovating. Getting BlueHalo integrated effectively is absolutely critical to the success of their entire transformation strategy.
All right, let's bring it back to the market's view, the valuation. Our sources pointed out it's exceptionally high, reflecting optimism about the future rather than current earnings. What does this really mean for potential investors? Is the stock priced for perfection?
It certainly appears that way. As of September 2025, their trailing 12-month price-to-earnings PE ratio was hovering around 150x.
150 times earnings, that's high.
Extremely high. It's substantially higher than their own 10-year historical average PE, which was already elevated at around a 129.5x. And it represents a massive premium compared to the broader industrial sector average, which is closer to 27x.
And compared to other defense companies.
Similarly stretched, their enterprise value to EBITDA multiple, was also very high. Various sources put it somewhere in the 113x to 127x range, if you compare that to peers. Kratos Defense is an outlier with a crazy high PE due to low earnings, but its EBITDA is around 70x. More traditional players like Textron are at 18.5x PE, Northrop Grumman at 21.4x, Lockheed Martin at 25.7x, you get the idea. AVAV is trading at multiples far, far higher than traditional defense contractors.
So the market sees them as a tech growth stock, not a defense stock.
That seems to be exactly how they're being valued. The valuation appears entirely forward-looking. It seems based almost completely on expectations for that massive backlog converting to revenue and the anticipated huge earnings power coming from the combined entity with BlueHalo, especially those new high-tech areas like space and cyber.
Which makes the stock very sensitive to news.
Highly sensitive to the growth narrative. Any disappointment, slower bookings, revenue growth, missing expectations, margins not expanding as hoped, could lead to a significant and probably rapid contraction of these valuation multiples. The air could come out of the balloon quickly if the story falters.
Let's connect that valuation back to the backlog we discussed. It's impressive, but how does it actually stack up against that $12 billion market cap? Our source had an interesting take on this.
Yeah, this really puts the valuation into perspective. As of Q1 FY26, their funded backlog, the confirmed orders, was $1.1 billion. At the same time, their market cap was around $12.3 billion.
So the funded backlog was less than 10% of the market value.
Exactly. Less than 10%. Even if you take the total backlog funded plus unfunded, which was $4.2 billion, that still only accounts for about 1/3 of the company's market value.
What does that tell us?
It tells us the current valuation isn't just reflecting the work they already have locked in. Not even close. The market is placing enormous value on the company's ability to successfully convert that $3.1 billion in unfunded backlog into funded orders. And beyond that, it's betting on them winning substantial new contracts well beyond the current total backlog. And, crucially, generating significant high-margin growth from those newly acquired BlueHalo assets in space, cyber, and directed energy.
So the stock price is really a bet on the future, not the present.
It's a bet on sustained multi-year growth, well beyond anything currently secured in the funded backlog. It's an expectation premium, plain and simple.
Okay, wrapping this up. For those of you listening and tracking AeroVironment's journey through this complex transformation, What are the most critical questions you should keep asking? And what specific metrics should you watch closely to gauge their progress and the risks?
All right, to really keep tabs on how they're doing against their own strategy and how the risks are evolving, here are the key questions I'd be asking. First, BlueHalo integration. How's it actually proceeding? Is management being transparent? Are they giving clear milestones and metrics to track whether they're achieving those promised revenue and cost synergies? Or is it all happening behind closed doors? Second, margin evolution. What's the real trajectory of adjusted EBITDA margins going forward? As that lower margin services business from BlueHalo becomes a bigger slice of the pie, can the company still hit its long-term margin targets? Or will margins be structurally lower? Third, sustainability of bookings. Can they keep up that incredible pace of new orders? Will that book-to-bill ratio stay well above 1.0? Or will the rate of new orders start to normalize now that the initial surge from Ukraine might be plateauing? Fourth, international diversification. Beyond the current hotspots, can AeroVironment secure large-scale programmatic wins in other key international markets like Europe or the Indo-Pacific? That's key to really diversifying away from just the U.S. budget and specific conflicts. And fifth, path to commercialization. Is there any tangible progress, FAA certifications, strategic partnerships that suggest a viable path to actually commercializing their military tech someday? Or does that remain a distant, maybe decade-long aspiration?
Those are great questions. And what about the hard numbers? What metrics should people monitor quarter to quarter?
Okay, key metrics to watch closely. Definitely track the funded and unfunded backlog, look at the absolute dollar values, and importantly, the quarter-over-quarter and year-over-year growth rates. That's your pipeline. Keep an eye on the book-to-bill ratio, calculated each quarter, new bookings divided by revenue. If it stays consistently above 1.0, that signals future growth. Below 1.0 means the backlog is shrinking relative to sales. Adjusted EBITDA and margin are crucial, since that's management's preferred profitability metric. Track how it performs against their guidance to gauge operational health, especially given the gap distortions. Monitor the revenue mix, product versus service. Watch how that percentage shifts over time to understand the impact on the overall company margin profile. Track international revenue as a percent of total sales. Are they making real progress on geographic diversification? And finally, don't forget R&D as a percent of revenue. Make sure they're maintaining that investment in innovation. It's absolutely critical for their long-term competitiveness.
Wow. What a journey through AeroVironment's transformation. We've seen a company pivoting incredibly fast, moving from being a specialized drone maker to aiming for status as a diversified defense tech prime. They're riding these powerful geopolitical tailwinds.
Huge tailwinds.
But they're also navigating really significant integration challenges with BlueHalo, facing intense competition in a rapidly evolving landscape, and doing it all under the pressure of a sky-high market valuation.
Yeah, AeroVironment's story is just a fascinating case study, really. It shows how a company tries to adapt and innovate in this incredibly dynamic environment. It truly is a microcosm of the modern defense landscape. You see that critical interplay between cutting-edge technology, shifting global security dynamics, and that relentless pressure for flawless execution when expectations are this high.
It leaves you with a big question, doesn't it? In a world where, like we started, even a $500 drone can potentially neutralize a multi-million-dollar tank. Is the whole future of defense shifting? Is it becoming less about massive, expensive platforms, the traditional ships, planes, tanks, and more about these agile, interconnected systems, increasingly led by software and AI?
That really seems to be the direction things are heading.
And if that's true, how many companies, especially the traditional defense giants, are truly prepared for that profound shift? What does it mean for their decades-old business models built on large-scale hardware? The AeroVironment story suggests the future battlefield might be won by speed, adaptability, software, and network systems, a fundamental rethink.
A fascinating thought to chew on.
Definitely. We encourage you to keep exploring these questions, watch how this plays out, and apply this knowledge as you observe the ongoing rapid evolution of defense technology.